Hi and welcome back. This is perhaps the most important lesson in the entire course. We're going to talk about what makes up a trend, and we'll get to the details in just a bit. I wanted to go over an extremely important concept. Price is everything. As a technical analyst, you rely only on price because you know that all relevant information will reflect in price. You don't need to worry about a recent earnings announcement. You don't need to worry about news because at any given point of time, you will notice that there is good news and bad news. How are you supposed to make a decision? A technical analyst knows that if the information is relevant, it will reflect in price, and all you need to do is react to it. Price is king. Now, this may seem like a basic principle, but the implications are incredibly powerful. Let's go back in time. Let's go back almost 3 decades, back in October 17th, 1987. If you're an investor, that day probably rings a bell. It's known as Black Friday. That's the day when the US Dow Jones, which is equivalent to the Sensex and the Nifty here in India, fell a staggering 22% in a single day. Here's a chart of that period. As you can see, the crash occurred mid-October and caused a sharp fall. From August through October, the Dow rallied from 2,400 all the way to 2,700 in just 2 months. That's a 12.5% surge. Now, what's interesting is that if you did a quick search to find out why the stock market crashed, there is no consensus at all. People talk about political events, inflation, introduction of computerized trading, and even overvaluation. Call me crazy, but if the world's top economists can't figure this out, then maybe their approach isn't perfect. And what's funny, actually slightly humorous, is that after the event, almost 33 prominent economists met in the US to figure out what actually happened. And they concluded, and I quote, that this will be the most difficult years since the 1930s. That's when the Great Depression hit America and completely destroyed the economic system. So why are we talking about something that happened 30 years ago? Because one savvy trader, Paul Tudor Jones, was able to short the market and make a huge amount of money. And it was based purely on technicals, on historical price data and statistics. What's interesting is that he used a little bit of fundamentals on the side, but it was a recurring pattern. He saw a downtrend, shorted it, and made money. For Paul Tudor Jones to have made that trend, he would have probably seen an uptrend change to a downtrend. Now, we know the 3 kinds of trends: uptrends, downtrends, and sideways trends. But how do you objectify them, and how do you know when they change direction? For that, we need to know what makes up a trend. It all starts with a rally, decline, which make up a swing high, swing low, and then form the entire trend. Let's start with a rally. Here is a single bar. Simple enough. Now we're going to add a second bar, which breaks the high of the previous bar. Also notice that this second bar has a higher low than the first bar. When you have multiple bars doing that, making a higher high and a higher low, you get a rally. A decline is just the opposite. The bar breaks the previous bar's low, lower lows and lower highs make a decline. A simple enough concept. You see, the meeting point of a rally and a decline is called the swing high. And the meeting point of a decline and a rally is called the swing low. Let's take a step back now and try to understand what a swing high and what a swing low is. Basically, it comes down to demand and supply. It is resistance and support areas. So when there is an overabundance of demand, when demand picks up, you will get a rally. Obviously, prices rise, right? But when supply overtakes that demand, prices will then fall. That point is your resistance point. It was the point that the bulls stopped winning and the bears overtook the bulls. The same is true for a swing low, which is naturally a support area. So when you have an overabundance of supply, prices will fall, and at some point the bulls will come in and start to buy and overswamp the supply, bringing prices up. That is your area of support. Now let's see this on a chart. This is Tech Mahindra. Now notice this is a weekly chart. Let's try to find out the swing highs. Now over here we have a white bar. This is 8,813. The high is 1,277. Okay. The next bar crosses the high. As we can see, the next few bars do the same thing. That, as we know, is a rally. After that, the two next bars are actually moving down. Very simple. That's our first swing high. Okay, let's move forward. We get nice, beautiful bars up. And then this bar, which is the highest point in this congregation. Notice the next bar is bullish, but it's broken the previous bar's low. So we still have this formation happening. This formation is extremely important. So this bar over here, which is the highest point in the congregation, 1594.5, is the swing high. Let's move forward yet again. We have another bar going up, and then sideways. Now again we have a bar congregation, that place that sticks out. That's the swing high, or the high is 1762. That's another swing high. Now here is where things get a little confusing. Let's look at this big bar here, and then we have a couple of bars going sideways. We have red bars and white bars. Where is the swing high? Well, it's very simple. When you have a congregation like this, where it's all sideways, look at the highest point. The highest point in this place is this red bar, and the red bar's high is 1906.1. That's your swing high. Simple. Let's move forward. You have another swing high here, another swing high here, another swing high. This is a small swing high over here. This is another small swing high. A rule of thumb is this: if you can walk 3 steps away from your laptop and still see a swing high, that is your swing. So you don't need to complicate this too much. Don't get into the rallies and declines thing. Spot it. You just need a little bit of practice. You'll see this one over here is another swing high. We have another swing high over here. I think the swing highs next are much more simpler to see. This is also a swing high. So is this. Now over here, it's actually very simple. You have few bars going up, and then you have 2 sideways bars. That's enough for this bar to be a swing high. So that's 2523. That's another swing high. Then we saw after this white bar, we had another bar going up, another bar going up. Now this is a new high. Notice this is brand new territory. And then we get a huge bar down. Now so far we don't have a swing high. We need this bar to complete. So as soon as this bar begins, great. We have a congregation. Highest point is actually the white bar, which is 2540. That's your swing high. And lastly, we have the last swing high here. And this area is the time now. Now you notice this looks like a swing high. I'll get that select out of the way. This looks like a swing high, but it's not a swing high yet. You see, as soon as this red bar completes and the next bar begins, that's when we will call this bar high 2630 the swing high. Just remember this. When a number of bars congregate, the highest point in that congregation will be the swing high. Remember to use the high, not the close. We want the highest point price went in that congregation. Now the same is true for a swing low. Here is a chart. These are all the swing lows. Did you get them all? Now that you understand what a swing high and a swing low is, we can understand what makes up the trend. You see, when you're talking about an uptrend, for example, what does it really mean? It means the stock continuously goes up, but not all the time. You get few dips in between, and all these dips are higher swing lows. So an uptrend is basically consecutive higher swing lows, which means every time market went up, came down slightly, there were more buyers to push prices back up again. Downtrends are just the opposite. They have lower consecutive swing highs. Check out this example of Cain India. During the last 7 months of 2014, crude oil prices began a long, arduous fall. Cain India, which refines crude oil, naturally saw its profits shrink. This got reflected in the stock price, and what do you notice? Numerous instances of consecutive lower swing highs. This is a downtrend. If you recall, I had said that this is the most important lesson in the course. Do you realize why? Because this is the foundation of what is going to tell us when the trend changes. Let's go back to the 1987 example. This is a weekly chart. Now place yourself in August or September of that year. Can you conclusively say that that was an uptrend? If you're unsure, don't fret. The next lesson is going to tell you exactly how you could have avoided this mess by using what you've just learned. Isn't it amazing how a simple chart can be so powerful? Now, what you just learned in this lesson forms the foundation to build an objective trading system. So if that intrigues you, I'll see you in the next lesson.